Markets, historically, they go up and, well, they also go down. But lately, it feels like equities only go one direction, up. So will it continue like this for the foreseeable future? And what should we know as investors to help us make the appropriate decisions for our portfolios? We're going to break that down for you in the next few minutes right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. I'm joined today virtually by Matt Orton, the head of Advisory Solutions and Market Strategy from our partners at Raymond James Investment Management. Matt, always good to have you here. It's a really good time to be talking about this topic with you because we're seeing, obviously, equities have had an incredibly strong run in the last year, and we're obviously heading here into the last 2 months of 2023. And they've done really relatively well, despite the fact that we've seen this surge in both nominal and real rates. I mean, we can't ignore what treasuries have been doing since the Fed, kind of announced that they weren't really going to be cutting anytime soon. So there's a lot that's going on. When could this eventually weigh more on the market and the economy more broadly, particularly with such elevated levels of volatility? What are your thoughts on that?
I like the way that you phrased the question, kind of asking, things have kind of gone well this year, and what might it take to derail what we've had? Because even though it's been a narrow market this year, the fact that the equal weighted S&P 500, I'll call it the market of stocks, is only flat to slightly down in the face of really significantly higher nominal yields and really meaningfully higher real yields, which better reflects the cost of capital, that you would think will have an impact on the overall market. But what I would say is two things. Number one is volatility, and interest rate volatility in particular is something that we have to follow. And until interest rate volatility starts to slow down, it's going to be difficult for the market to really find its footing. This year, when you look at this year and last year, over the past 20 years or so, it has been extreme with respect to the amount of volatility we've had. I mean, we had 23 instances of weeks last year where the 10-year rate moved more than 20 basis points over the span of a week. That's big. We're on pace to almost match that again this year. So there's been a lot of movements. That's been problematic for the overall market. But hopefully the overall market can start to migrate from thinking about the macro and what's impacting the macro and look at the fundamental picture. Because at the end of the day, the economy is still doing all right. I think we've all underappreciated the dramatic impact of zero interest rate policy for the past 13 years and really how that's blunted a lot of the pain we would have expected to feel at that point. Doesn't mean it's not coming, but it means that the pace of it coming to the economy has slowed down. It's probably been blunted a little bit. And so once this market can find its footing and actually focus on the fundamentals, I think we have a pretty good base on which we can build, whether it's later this year or into 2024, because earnings are increasing again.
Great. Yeah, thanks, Matt. Great way to get started. And you bring up the 10-year. We were looking at treasuries all the time. And in my entire 25-year career in this industry, I've never seen rates move so rapidly in such a short amount of time. So it is a bit of a head spinner for the equity side, right? But given the risk of this kind of higher for longer and elevated rate volatility, in your opinion, what matters more right now? Is it yields, or is it earnings, or is it maybe somewhere in between?
Yeah, Anthony, I would say it's both. I mean, both matter at the end of the day. I think rates have mattered. Rates mattered a ton last year because think about it. We have had the most rapid rate increase cycle over the past 40 years that occurred last year. And last year was much more about adjusting to higher rates. And that's why both the equity and bond market performed so poorly. This year's adjustment is more to this concept of higher for longer, or I'll say high for longer, because I think the Fed is done hiking at the end of the day. But rates are going to remain at restrictive levels for a longer period of time, and I think we've largely adjusted to that. So I think the impact, or the most meaningful impact of rate increases, has probably already been felt, or we're at the tail end of the market digesting that. But going forward, earnings ultimately are what should drive the market. That's what we're valuing the market on going forward. And so we're finally coming outside of the Magnificent Seven and energy last year. We had a pretty significant earnings decline. We actually had double-digit earnings decline last year once you strip energy out of the picture. This year, we're finally building on that. And I think you're going to see decent earnings growth, probably beating expectations in the third quarter. And then next year, expectations are for 12% earnings growth. And I don't think that's unreasonable given a still, I'll call it, benign economic backdrop. So what I would say to clients is follow the earnings at the end of the day. Focus on companies that are able to grow their earnings, not just the top line, but grow the bottom line and still have margin as well, because that's going to matter the most at the end of the day.
Yeah, and you brought up energy, which I know is one component, one sector that does have some quality in there. And you've talked about quality and the importance of it in some of the more recent notes that you've been writing and some of the things that I've had a chance to look at. Maybe you can define a little bit more how you view quality, and maybe, as I said, with energy, there are some other areas that you could maybe perhaps highlight for our viewers where investors might want to find some quality companies and where they should be focusing their attention.
Yeah, I think there's so many different ways investors define quality. I have my own way of doing it. I think at the most basic level, I mean, just think about quality from, I'll use like a hamburger analogy. So if you're looking at quality, you can go get a burger at a Red Robin, or you can go to like a PJ Clark's in New York City or a Fleming's. It's going to be the same size, the same weight. Taste is going to be very, very different, and how you feel afterwards is probably going to be very different as well. So it's a different experience. It's the same thing with companies. Quality companies to me aren't just companies that have good balance sheets, that don't have too much debt. But what's equally as important, probably even more important to me for quality, is the ability to grow the bottom line. So I want companies that have both near-term and medium-term EPS growth, not just profitability, but growth to the bottom line. And you also have to have free cash flow, especially as real rates continue to move higher. The ability to finance that growth and grow the bottom line is important. So pay attention to free cash flow yield. Better free cash flow and yielding companies are higher quality companies to me at the end of the day. And so there's a lot of those companies in the market overall. You just have to look for them. And energy, like you mentioned before, Anthony, is a sector that I've liked for a while right now, because a lot of the energy companies have cleaned up their balance sheets. They're making more prudent capital expenditures. You have oil prices that look to be range bound, given both geopolitical problems going on around the world and the fact that there's a supply and demand imbalance. So you have a lot of positive tailwinds for these companies, and you're seeing these companies pass the most difficult comps for them on a year-over-year basis. And on top of that, energy companies are positively correlated to real rates. So that's a nice hedge to keep in a portfolio as real rates continue to rise. But you can also find quality companies even in information technology. People love to hate on the Magnificent Seven because they've done so well, but a number of those companies are high quality companies because they've got hundreds of billions of dollars on the balance sheet to fund their growth. And they have long-term secular growth tailwinds with good bottom line growth and really good margins. Industrials is a place, certainly a little bit more cyclical, typically associated with the overall economy. But a lot of the industrial companies, again, cleaned up their balance sheets during COVID, used cheap debt to do so they don't have a lot of liabilities. And they're leaning into some of these mega trends, I like call it reshoring, coming back to the country, supply chain management. All of that's benefiting a lot of those companies. And aerospace and defense fits in there too. And you're seeing countries start to finally spend more on aerospace and defense overall. So there's a lot of places you can find quality. You just have to look for it. And at the end of the day, quality has been outperforming. If you look at this market over the past couple of months, past 5-6 months, quality, no matter how you skin that cat, it has outperformed the overall market. And I think it's going to continue to do so going forward as selectivity increases in importance.
Great. And for more information from anything that's coming out of our great partners like Raymond James or anybody in our CIO, please check out our website at ubs.com/views. You can also follow us on social media. We're on all the major platforms, including Instagram. You can check out our dedicated @UBS Trending channel for all the studio's content that you're not going to find anywhere else. And as always, if you have questions about your own portfolio, make sure you're speaking with your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.